Thank you. Good morning to everybody. I'm aware the language of the conference is English, but lieber Volker, kann ich nur sagen, wie es immer meine Freude ist, in Deutschland und in Frankfurt zu sein. I switch back to English. Oh, you are so far away. My role is mainly to be the timekeeper, so I will not waste time in my introduction. Let me stress that perhaps this panel is the most exciting and challenging, but I look to my two colleagues, José Luis and Joachim. The two panels this afternoon will be also of very high interest. But we will speak this morning about the economic environment faced by ECB monetary policy. And as the President just said, obviously, it's not the easiest task, but you will help us. We are aware that this environment can change tweet by tweet from one day to the next. So you will have the misfortune, or the fortune, we will say, to try to explain to us something which could be reversed this afternoon or tomorrow, but we will see. We live in a world not only of uncertainty, but still more unpredictability, and still more these last days, irrationality. And we as central bankers have to bring in this world rational, being predictable, and, as Christine said, reduce uncertainty. So it's really a paradox. How can we be predictable without being pre-committed? Or, to use the President formula, which I liked much, combine agility and clarity. You will try to help us. The rules of the games are clear. Each of you has 15 minutes. Then we will turn to some lead questions and we will open the floor for everybody. We will, as a whole, till 11:45. I don't need to be long either in introducing our distinguished speakers. Can I only say, Silvana, that you are professor at the London School of Economics and former external member of the Bank of England Monetary Policy Committee till 23. Klaus, that you are professor at University College in London and perhaps on leave at University of Mannheim, not very far from here. And Refet, that you are professor of economics at Bilkent University in Ankara and a research fellow of CEPR, where you are the director of the Monetary Economics and Fluctuations Program. So 15 minutes each for this difficult task. And Silvana, you are the first speaker and you are ready to give us, if I understand well, the global picture. So let us start with the global picture.
Thank you very much, François, and thank you very much for the invitation. There's a lot going on at the moment in economics and in politics. And in my presentation, I will try to focus on the big picture for the Eurozone, where it's coming from. Can I move this? How do I click? Sorry. Thank you. Okay, there we are. So in my presentation, I will talk about where the economy is coming from, where is it now, and where it might be heading to. And in doing so, I will draw some comparisons with the US economy. Starting from where we are coming from, we've had two phenomenal once-in-a-generation shocks, the pandemic and the Russian invasion of Ukraine, which led to an extraordinary increase in the prices of energy and other commodities. This was the most remarkable confluence of tail shocks or rare events. To give a sense of magnitudes, the energy shock alone was comparable and even larger than what we experienced in the 1970s. This is illustrated in this chart showing the growth rate of global oil prices and European natural gas prices. So this illustrates that the 2020s energy shock alone was at least as bad as the 1970s. These are global wholesale prices. Let me show you what happened to retail prices, what consumers and companies actually face, and the component that directly enters the CPI or PCE basket. We can see that despite this being a global shock, in the euro area, the cumulative increase in retail energy prices was actually much higher than in the US, reaching a peak of over 80% compared to a peak of 35% for the US. And we can also see in the chart that a gap of over 20 percentage points continued off-peak. Crucially, and this is a very important point, the energy and commodity prices were a negative terms of trade shock for the euro area. This is because the euro area as a whole is a net importer of energy and other commodities. However, for the US, this was a positive terms of trade shock. As a net exporter of energy and other commodities, moreover, the US is a major exporter of military and defense spending, so in all fronts, the war in Ukraine represented a positive terms of trade for the US. Negative terms of trade shocks put a very difficult trade-off for central banks, whereas positive terms of trade shocks pose no trade-off. And this is a crucial distinction between the two economies. This is, of course, not just a story of energy prices. We know that the pandemic also led to a big increase in the demand for global goods over services, which together with supply restrictions caused a big increase in global good price inflation. Arguably, this pandemic shock was common to all jurisdictions, but what was different across the Atlantic was the response to this shock, the fiscal response. As we can see in this chart on the left, the fiscal stimulus in the US was considerably larger than in the euro area. And this got reflected in real households' incomes, which we see in the right chart. Households' incomes in the US, real households' incomes, increased above trend during and after the pandemic, whereas in the euro area, they saw a marked fall below pre-COVID trends. So just to summarize, these very rare events impacted the euro area and the US very differently. The euro area faced a negative terms of trade shock and less fiscal stimulus, which meant that the ECB faced a much more difficult trade-off. As we know, monetary policy is an aggregate demand tool. Raising interest rates lowers inflation and expected inflation by slowing down current and expected aggregate demand. When inflation is demand-driven, we face a divine coincidence. By raising interest rates, we can both return inflation to target and restore output to its potential. However, when inflation is driven by adverse cost push shocks or supply shocks that weaken activity, then we face a trade-off. By reducing demand in order to reduce inflation, we also exacerbate the weakness in activity caused by the shock. So arguably in Europe, as I said, inflation was overwhelmingly driven by cost push shocks or supply shocks driven by the energy price increases, whereas in the US, inflation had a much bigger demand component. The ECB and the Fed reacted by tightening policy rates by roughly the same magnitude, as illustrated here, and the combination of shocks and policy responses meant that in the euro area, households' medium-term inflation expectations moved very little. This is the measure on the right, gauged by the 3-year ahead inflation expectations in orange for the euro area. Even though naturally 1 year ahead inflation expectations mimicked the dynamics of the inflation shock. turning to financial market measures of inflation expectations, a big development was a re-anchoring of inflation expectations after many years of having hovered well below the 2% mark. And we can see the patterns of activity behind all this. In the US, consumption today is more than 11% above what it was before the pandemic. It grew above pre-COVID trends since the middle of 2021, whereas in the euro area, consumption today is barely back to its pre-COVID level and well below its pre-COVID trend. The inflation dynamics reflected the dynamics of the shock. One thing I would stress here is that inflation, despite the shocks here being much larger than in the 70s, we had not just the energy shock, but the pandemic, inflation was kept lower and returned quickly back to close to target. So to sum up, we had a 1970s shock plus a pandemic, but combined with a 1990s monetary policy framework. And the outcome is that the framework worked. Despite the big challenges posed by this rare event, inflation was returned to target within a reasonable period of time, reasonable given the times in the transmission of monetary policy, the lags in that transmission. And so we can say that this flexible inflation targeting framework fared well. I mean, incidentally, this combination of lags and cost push shocks is the reason why we have flexible rather than strict inflation targeting regimes, as Madame Lagarde said, in response to a large cost push shock. The role of a well-designed monetary policy is to return inflation to its target within a reasonable period of time, making sure that inflation expectations in the medium term remain anchored, and I would add that there's limited damage to potential. So I would say that the framework passed the test fairly well. Now, where are we now? We've seen the unwind of the energy shock and its indirect effects, at least partially, and we saw the unwind of the various supply chain constraints. Yeah. On the other hand, monetary policy, of course, has remained restrictive up to now. This reversal of the supply shock is effectively a positive supply impetus for the economy, and this has pushed up on activity and down on inflationary pressures. Meanwhile, restrictive monetary policy has pushed down on activity and on inflation. So the combined impact of these two forces, demand and supply, has resulted in lower inflation and on net for activity on stagnation, as shown in this chart, showing GDP for the US and the UK, and we can see clearly the stagnation in the euro area. So what happens next? The immediate threat to the global economic order are tariffs and trade wars, and the uncertainty surrounding them is enormous. This graph here shows the average effective tariff on US imports since the 1920s. You've probably seen this graph many times these days. And we can see the effect of the first Trump administration moving the tariff rate from roughly 1.5% to 3%. And what I did here is add three scenarios that were mentioned at different times by President Trump. The bottom scenario shows a 20% tariff on China, presumably what we have right now. The middle scenario adds to that a 25% tariff to the European Union, Canada, and Mexico. And the top scenario shows adds another 40 percentage points to China, getting to 60% tariffs on China, which was what Trump mentioned in his campaign. And this takes us far above the peak in the 1930s. I should also add here that because the US economy is twice as big as it was back then, these higher tariffs will have a much bigger impact on the US economy than they had in the past. But the uncertainty around these numbers is enormous, as President Lagarde said. This is probably what she was referring to. This trade policy uncertainty index from Keller and co-authors shows a huge spike as I speak. So we don't know how persistent these tariffs will be, amongst other things. What we can tell is that this will have an adverse effect on average incomes and global growth. The effect on prices is less clear-cut. For the US, it might be that the effect is fairly contained. Let me walk you through some back-of-the-envelope calculations here. US imports are about 10% of GDP. 60% of those imports come from the EU, Mexico, Canada, and China. So if we follow roughly my scenario B, a 25% tariff on all these 4 jurisdictions will lead to an increased direct impact on prices of 1.5 percentage points. This would be the aggregate price level. This pass-through to retail prices may be reduced by a dollar appreciation, by exceptions on products, exporting cutting prices, importing cutting their margins, some trade diversion from countries that are not affected by the tariffs. And we saw a bit of this during the first Trump administration. The pass-through was far from complete. On the other hand, we are coming from a period of much higher inflation, and the second round effects might be bigger this time. Also, the size of these increases might be higher or widespread. So the visibility of these tariffs might have an impact on second round effects. In countries on which tariffs are imposed, say Canada, China, and so on, we should expect to see lower export and exportable prices. There is an excess supply of these goods now that needs to be placed somewhere. If there is retaliation, of course, this will lead to increases in retail prices in those economies. Finally, in third countries or by standards, we should see lower import prices on tariff-affected products, and this is what we saw in the first round of tariffs during the first administration, as we document in a paper with Alberto Cavallo and Feodora Tetti. So how should central banks think about these tariff effects? Well, for third countries, there's no trade-off. This should lower activity and lower price pressures. For the US or any country imposing retaliatory tariffs, there might be a trade-off with lower activity and higher price pressures. If these price effects are small, then see-through strategies would be the natural policy. But if the price effects are more substantial and there is risk of second-round effects, of course, we will need more tightening relative to the no-tariff scenario. For all countries, we can be certain that there will be more uncertainty, and that would be a big factor playing everywhere. Now, where we might be heading to, I think now the new factors on the table, the increased defense and infrastructure spending, which obviously will boost demand and put higher price pressures. The question is how much, what will be the pace, and it might also have effects on capacity in the longer term, and there's a very nice paper by my colleague Ethan Ilsetsky on this. Other factors to weigh, the evolution of energy prices, which will follow the resolution or the risks from escalations on the war, so this will be a big factor in the mix. So far I discussed one-off effects from tariffs, but there could be continued fragmentation, and here the effects on activity are clear. It will tend to depress activity, leading to more inefficiencies. The impact on prices are more ambiguous, and this is a point we made with Ludovic Ambrosino and Jenny Chan. It depends on how much of these negative impacts on future productivity and future higher imported inputs are anticipated by investors and consumers. If these effects are anticipated, then we might have even disinflationary pressures Thank you very much. And then, of course, there's AI with its positive effects on productivity, but also with a lot of uncertainty on what it might do to labor markets and demand. And this will be part of the discussion in coming meetings. So I'll leave you with my 4 takeaways. The euro area and the US face very large shocks, but the impact on these economies were very different, and the fiscal response was very different. The monetary policy framework in the euro area worked well, returning inflation to target in reasonable time, despite the enormous size of these events. Restrictive monetary policy is an imperfect tool to address cost-push shocks and supply shocks, but it's the only tool we have from the perspective of a central bank. All else equal, one would expect that restrictiveness to be removed as the shock unwinds. However, as I highlighted, all else is not equal, and there are many factors that are entering in the mix now: defense and infrastructure spending, tariffs and trade fragmentation, uncertainty, AI, the resolution or escalation of risks in Ukraine, energy prices, and the list goes on. So I'll pause here. Thank you, François.
Thank you very much, Silvana. You succeeded to be at once clear and open on your conclusions, and it's not that easy. You mentioned several times fiscal, which is a perfect transition to you, Klaus, because I understand you will speak about the new fiscal outlook.
Yes, thank you very much. So it's great to be here, and also thank you to Volker Wieland for putting me on the panel. It is my task now to speak about the fiscal policy challenges and what these imply for the ECB strategy and policy going forward. Yes. So I think it's clear that that was too much. Okay. So it's clear that somehow more euro area government debt is ahead. We have to invest in defense that has been neglected for decades. This requires materials and people, and is going to not be financed straight out of taxes. And this comes on top of other challenges that Western European societies are facing: green transition, digital transition, aging societies, all of which put additional strains on government finances. Now, the euro area starting position to tackle all this is now slightly worse than before prior challenges, before the COVID crisis or before the great financial crisis, because both debt and deficits are higher now, and on top, of course, come the geopolitical uncertainties and other uncertainties that we are facing, which aren't making things easier. Now, how should ECB policy respond to that? And I will try to argue that it is imperative to focus on the narrow goal of achieving price stability. And I'm very glad that actually President Lagarde quoted Thomas Jefferson. I'm quoting here the former president of the ECB, Trichet, who always emphasized that the ECB needs to be vigilant about inflation. And I think this is going to have very beneficial effects, especially in periods in which government debt is high and higher than it used to be. In particular, it can contribute in many ways to ensuring more favorable government financing conditions. And in this sense, there is going to be no trade-off. In fact, there's going to be complementarity between the goal of achieving price stability and the goal of achieving favorable government financing conditions. So that's going to be one argument. The second argument is going to be that even though in historical comparison the euro area now isn't looking as good as before prior crises, it is still the most attractive amongst the world's biggest currency areas. In particular, it has lower debt and lower debt deficits than any of its competitors. And I would even say now we can argue it has more credible and stable institutions than any of its competitors. Now, with a return to independent defense and being independent from others, and perhaps return to more sustained economic growth, I think we are very good position to eventually become the dominant international reserve currency. And I think we should try to aim at this and be ambitious on this front, because a lot of additional effects come from that, especially in times of high government debt. And I think the ECB here again, by focusing on a narrow mandate, could help in fostering the establishment of this dominant reserve status. Of course, it could add through many other ways. Digital euro is one, if this is sort of offered in a way that facilitates transactions abroad and makes it easy to get access to euros. This is going to further reduce financing costs at no cost to price stability. Now, let me show you the euro area debt picture. Before the great financial crisis, we started out around 65% of deficit to debt to GDP ratio. Then before the COVID crisis, we had already 85, and now we're at close to 90%. So we are slightly worse, not much worse than before tackling the COVID crisis, but still substantially higher than we have been in the past, especially prior to the global financial crisis. What isn't looking as good is the deficit numbers. So the debt has come down, but not so much by cutting deficit, but by having high inflation and essentially expropriating long-term bondholders in certain ways. You see this here. So prior to the financial crisis or the global the COVID crisis, we had deficit ratios of around -1%, so pretty close to balance, and we had substantial fiscal room to expand spending in the subsequent crisis, and this now looks much worse. We are at around a 3% deficit number, and the room for spending is, of course, less generous than it used to be before prior crises. Now, while this doesn't look too good, it still looks great, I would say, in international comparison, and we should remind ourselves of that. Here you have the debt to GDP ratio of the United States and China, and you can see China, this ends in 2023 because official numbers for 2024 aren't out yet, but it's very likely that China overtook the euro area debt to GDP ratio in 2024 already, and the United States has done so already at the great financial crisis times. And more of that, on top of that, you see that the trajectories of those other economies are much steeper than the trajectories we can see in the euro area. So if you look at the increase in China, it went from 40% to 85% in less than a decade. And if you look at the future deficits that are going to come out, this doesn't look as anything that's going to revert anytime soon. If you look at China's deficit to GDP numbers, these are now IMF forecasts of overall government balance and net borrowing. It's at around -8% of GDP. -8% of GDP. And for the US, this is below -6% of GDP all the way out to 2029. So in this comparison, a 3% deficit to GDP number, which of course does not yet include the additional spending that has to be undertaken for defense, which may add a percentage point or maybe 1.5. It still is the case that the euro area looks much better in terms of the level of GDP and the level of deficit to GDP. Debt to GDP and deficit to GDP. Okay, so what this also tells us, especially the large amounts of borrowing in other currency areas, is that there's going to be a global surge in government debt ahead. It's not only the euro area that will have to borrow a lot, it's going to be even more so these other big economies that will have to borrow a lot. And the question is, how can we deal with that? So the first recommendation I would have is a narrow focus on price stability in the strategy would be desirable. We have had the luxury in the past to expand into other areas, and that was all legitimate, but I think it's valuable to return now to the primary target. This is going to keep inflation premia and inflation risk premia on government bonds low, and that is going to be imperative to be able to finance the additional debt. And I'm going to argue in a second that even now inflation risk premia aren't small, and we can use the recent German expansion to see what they make up, how much of the increase in yields they make up. And it also is imperative because it's going to safeguard the narrow focus on price stability, ECB independence. That is especially important when, with a large amount of debt being around, monetary policy decisions going to have more fiscal implications than in the past. And you want to keep your head down in order not to be dragged into other policy areas in order to do what you're able to do. And independence is key for keeping inflation risk premia and government finance premia down. It's also going to promote, I would say, the euro area as a safe haven if you can have credible institutions to price stability and the purchasing power of the euro. And it's going to help in establishing, prospectively at least, the euro area as a dominant international reserve currency. So through all these three channels, it is the case that price stability focus is going to keep also financing conditions favorable. And I think that's something that would be very good with high debt. Now, let me show you that the recent German experience, where we got news last week of a big fiscal expansion, is actually suggesting that even now inflation premia and inflation risk premia are not negligible. Okay? So we can see here, I picked the German 8-year nominal Bund, and on Wednesday last week, the news came out of the big fiscal plans that the prospective new German coalition is going to have, and that led to a jump in yields. Today's numbers are even a little bit higher, but it increased the 8-year yield by around 35 basis points nominally. So why did I pick an 8-year bond? It's a bit unusual. Well, because there is an 8-year real bond outstanding of the German, an inflation index bond that we can also look at. And the yield of that one moved from around 52 to 77.77%. So is an increase of about 25 basis points and is therefore 10 basis points lower than the nominal increase. And this suggests that roughly, at least for this episode, inflation and inflation risk premia make up almost a third of the yield increase. So it's really important to contain these because they seem substantial and you don't want to get them any higher. Okay, so now let's look at more global other implications of the global government debt surge. I think the international competition for savings is going to definitely heat up with governments around the world trying to borrow more. And this is likely going to impose some long-term real interest rate pressure upwards, or even the natural rate may go up. Unfortunately, we do not have very up-to-date and very reliable estimates on how big the effects are, but this is something probably that could be looked at in the strategy review. The perhaps most reliable numbers we have come from Thomas Laubach, who used to be here in Frankfurt and was then at the Fed, and they are for the United States, and these estimates suggest that every percentage point increase in the US deficit to GDP ratio raises long-term yields by around 25 basis points, and every 1 percentage point increase in the debt to GDP ratio increases 3 to 4 basis points the yields on the long-term US government debt. I think what is urgently needed is a quantification here for the euro area. That would be highly desirable, especially in an environment where not only euro area supply expands, but also global supply expands, and this may generate additional effects. Now, the long-term rate increase has positive and negative effects. For the Eurosystem, there is a positive effect because Eurosystem will return to profitability in the long term. That's good. Capital is going to be rebuilt. The losses are going to disappear eventually, and that is good for credibility and containing the risk premia in government bond yields. There's also going to be, as a result of a higher long-term real yield and possibly short-term real yields, a lower risk of hitting the lower interest rate bound, which has proven to be quite costly in the end, and avoiding that would be great, and that's both positive for credibility of the euro system. Now, of course, for governments, this is unwelcome news. Financing the increased deficits is going to become more expensive, and I think that is just reinforcing the message that low inflation risk premia are really of the essence here going forward. So to conclude, there's going to be a surge in global government debt ahead. The focus of the ECB on its primary mandate is imperative, and it's going to have a number of beneficial effects. It's going to keep inflation risk premium down. It's going to safeguard ECB independence. It's going to promote potentially the euro as an international reserve currency. In this sense, price stability and favorable financing conditions for governments are complementary, and that is, I think, a very positive piece of information. Thank you.
Thank you very much, Klaus. Many things were music to our European ears, I must say, in the present environment, especially what you said about the impossible international role of the euro and the digital euro, slide 4. But we'll come back to it. Refet, you are the last one, and you will give us some views about the framework, I guess.
Turn this on. Okay, so here is something that you have seen. This is inflation from 2005, at the end of 2005 to the end of 2023. There is the global financial crisis, and then inflation is low, and it remains low for a while, and then there's COVID, it plummets, and then it shoots up post-COVID, and then it comes back down. Now, what is a bit less familiar about this is the scale, where this inflation peaks at about 3.5%. That's not our euro area. This was Switzerland. And it's actually very instructive to think about how it is that this tiny island of franc in a sea of euro is able to have such a different inflation experience than the euro area itself. The answer turns out to be almost exclusively energy prices. Switzerland produces electricity domestically and is price controlled. That lesson actually extends to all over Europe, not only euro area. These blue points are a whole bunch of emerging European countries. And on the x-axis, we have the weight of energy in their consumption baskets. On the y-axis, we have the cumulative inflation between 2021 and 2022, okay? More or less from the trough of inflation to the peak of inflation. It lines up rather well. You see Switzerland as the lowest inflation country. It also has a very low weight of energy in the consumption basket because of the price control. Studying this, I learned that Albania has tiny amounts of oil and gas, tiny by global standards, huge by Albanian economy, and therefore they are actually net exporters of energy. And here we have the euro area. This is true for the headline. It's also true for core inflation. The pass-through of the energy shock to core inflation was very strong. And we can see that within the euro area as well. This is a extremely well-fitting regression line, if there ever was one. This is the weight of energy in the consumption basket on the x-axis and cumulative core inflation on the y-axis within the euro area. Looking at these, it's very difficult to make any argument other than there was a colossal energy price shock that turned into headline and core inflation in Europe. Given that, one would like to disprove the argument that this whole inflation was a big policy mistake. And one would, of course, would like to have some idea of what a big policy mistake looks like. It looks like that. This is my favorite country, Turkish inflation. And as you can see, it looks nothing like the rest of emerging Europe. That was homemade inflation due to really badly designed policy that the policymakers insisted on. My conclusion from this, and I don't think I'm alone in this, is that post-COVID inflation in Europe overall, not only in the euro area, was not a policy mistake. It genuinely was a, in a sense, healthy response to a large external shock. It had to happen this way. It's a different story in the US. Silvana made some very good observations on that. The US fiscal expansion had different dynamics, and energy prices don't play the same way in the US as they do in Europe. It's also the issue that to have inflation no longer go up. One does not need to see energy prices go down. It's enough that they don't keep going up. We move from one price level to another one, it's done, and it is done. Now, what would we make of this in terms of the policy framework? I fully agree with Silvana that this is an example of the policy framework showing that it was working as designed. Inflation went up, it came back down within the existing policy framework. There were issues, and I would like to think that, and this is in one of my later slides, although the policy framework isn't broken and is no need to be fixed, there are things that can be tweaked at the margins. One is this communication about supply shocks, where we see these as transitory. We've heard this a lot. Inflation is transitory, more in the other side of the Atlantic than here, but here too. And I think this is not the right way of talking about inflation for central bankers. It's okay for me to say this, inflation is transitory. But for central bankers, inflation should never be something that is external to them. Central bankers say inflation is transitory, and I hear, not my business. Inflation cannot be not central bankers' business. That sentence should have been, inflation is transitory. If not, we will make it so. That's the way central bankers should be approaching inflation overall, regardless of the source of the shocks. Now, looking at the experience with the post-COVID inflation, my sense is that the ECB policy framework is not in grave need of revision. It has worked well, and it doesn't need a wholesale change. The Fed's is different. In the last revision, the Fed actually changed its own framework a lot and turned it into a framework that is really appropriate for a low inflation environment. The current Fed framework is the answer to how do we get out of prolonged low inflation? Right? Well, we are out of prolonged low inflation, so that framework will have to be addressed. That's not the same in the euro area, and therefore we're not in the same need of revising our own framework. Now, having said that, there are things that can be addressed without changing the framework in a wholesale fashion. And I have 4 topics that I'd like to briefly address. One is the transmission of monetary policy. We don't understand euro area as well as we should, still. After 25 years of having the European Central Bank and thinking about the entity that is the euro area, one of the key components of monetary policy design isn't sufficiently well understood. We don't sufficiently understand what happens once ECB moves. The ECB has or the Euro system has a wonderful research network now, CHAMP, that works exclusively on this. The fact that that network exists also supports the idea that more is needed to understand transmission. One of the issues here is, unlike in the US, the moment we begin to think about transmission in the euro area, we begin to think about heterogeneity. Monetary policy doesn't affect Portugal the way it affects the Netherlands. Very true. But that focus on countries forces us to forget that countries aren't necessarily natural units of observation. European Union is a union. Euro area is a monetary union. And in fact, the only truly relevant unit of observation is the euro area. If I asked, what was the GDP growth rate in your countries last year? Almost everyone here will be able to answer. If I ask what it was in the euro area, few of you will know. And that actually is a problem. That we don't treat the euro area as a proper unit of observation. But for the ECB to function the way it's intended, we have to see the euro area and not the individual constituent countries as the object of ECB policy. If we're going to look below the euro area, there are a lot of dimensions of heterogeneity that one could think of. And these are not correctly summarized by the countries. You might want to think about sectors. You may want to think about other geographic areas. You may want to think about skill levels. You may want to think about a whole host of issues, firms that are better capitalized, worse capitalized, but not necessarily Spanish firms versus German firms. So we really have to move out of that fixation with the countries. And that's something the ECB is uniquely suited to force the euro area population to think about. The other one is thinking more about scenario analysis. This is something that we are used to doing for financial stability purposes. For macro policy purposes, we do less of this, and I would say not as well. The issue is, of course, it's fun to think about what could go right, but we're paid to think about what could go wrong. And thinking about what could go wrong isn't easy. There's a lot. Usually, we take the slightly easier path of, among the likely things, what is the worst? But that really makes us blind to the really, off the left field, didn't see this coming type of shock. Now, by definition, some shocks will be truly, we couldn't have imagined this. I don't think any of us would have said in 2019, yeah, a pandemic will happen, may happen, that's going to force all of us to our homes. On the other hand, the following line of thinking, I think, is useful. Not just among the likely things, what is worst, but regardless of likelihood, what are some of the terrible things that can happen? Now, of course, the answer is, the sun goes supernova tomorrow, okay? That's not a policy concern. So, some of the things that we should be thinking about is, we're now finally talking about fiscal expansion in the euro area. What is the worst way this can play out? It's not among the likely ways that we're now thinking. If it's that, how can fiscal policymakers truly make monetary policymakers go crazy, right? Or in terms of energy, what would happen if Russian gas never resumes and the rare earth materials that are needed for the green transition fall victim to a trade war? These are the kinds of really horrible scenarios that, in most of which the ECB or any central bank will have to say, I can't do anything about this, but we'll have to have the right language for it. And you can't come up with these things on the fly. So it's really important that we think more about these things. The other one is having more clarity about policy asymmetries. Monetary policy, and in fact all policy, is asymmetric in the sense that if you're below your inflation target, you're much less worried about a policy error that's going to make inflation go up. In fact, that's going to make you happy. Indeed, in 2020, there isn't a single policymaker who wouldn't be happy if they were told, in 3 years' time, your problem is going to be inflation above your target. Now it's different. Now that we are in a higher inflation environment, the risk is that we're not going to be contractionary enough. Easing is going to happen too soon. Inflation is going to go back up again. That asymmetry is inherent in human behavior. It's inherent in monetary policy design. And it's one of the reasons why the press and the analysts oftentimes complain about central banks being behind the curve. Central banks should be behind the curve because you don't want to fall into whatever your problem was deeper by moving too early. Making this point and getting this understood is one of the more important policy aims, so that this talk about the central bank doesn't get what's going on, the central bank doesn't care about what's going on, does not take place any further. All of these culminate into a need to think more about policy communication. And this is something that President Lagarde touched upon eloquently too. My preference here is that there is going to be less of that communication. Less communication by less people on fewer topics. This is one of the problems of current central banking that in particular with large committees, there are a lot of people who may be talking about the central bank or maybe talking about their own opinions, and without listening to them, it's impossible to know which one they are going to be talking about, and hence, they take a lot of their attention. Human attention is limited. Market participants' attention is limited, and it's valuable. And central bankers should value people's time and processing power. It's important that policy communication is, in a sense, a bit more centralized. That is, the central bank governors or a few high-ranking officials that do the communication on behalf of the central bank. And I agree with Klaus here that they stick to monetary policy. Having a podium to speak does make one talk about any and all topics that are important, but not all of these are central banking topics. So it's important that when the central banker talks, people listen, knowing that they're going to be talking about central banking. Now, there are other issues. When I talk about the policy framework being appropriate for today too, and, perhaps it should be tweaked at the margins, it doesn't mean that there aren't larger issues to be addressed. It's just that those issues aren't ECB's issues to be addressed. They are not under the control of the central bank. Nonetheless, these are things that the central bank will have opinions about and should counsel the rest of the policymakers, including things like the fiscal and capital markets union, how decision-making happens in the EU, the demographics, and related to that, immigration, and how decision-making is done within the European Central Bank. A 20-member governing council is a large governing council. It's only going to get larger. Is this the way that we want to move forward? This is a very tricky political question that the ECB cannot answer on its own, but has to have its own opinions and should begin to push in the right direction, whatever right direction they think is the direction. Now, with that, I think I'd like to go back and reiterate that we are effectively done, in particular in Europe, with post-COVID inflation. And that should not be what is driving our policy framework thinking today. That's the last war. It is the case that we don't know what the next war is going to be. Had we known, we would have taken precautions for that already. There is a reason why shocks are unforecastable, right? And policy has to scramble every time a shock is realized, because if we knew this was going to happen, we would have taken our time and done the right policy already. Nonetheless, although shocks are not forecastable, once we see a shock, we should have a good understanding of how the central bank is going to react to this. This once again echoes President Lagarde's talk. And indeed, this is the definition of what the monetary policy framework is. Having a good, well-understood framework makes the life of the central bank much easier on two fronts. One, internal decision-making is much easier because we know if this happens, we're going to do that. But two, you have to do less of it because markets do your job for you if they understand how you're behaving. In both of these regards, I think the current ECB policy framework works rather well, and there is no need to fix what is not broken. I'm a fan of regular reviews of policy frameworks. It's a sign of humility that the central bank understands the framework is not going to be the right one forever. But currently, it remains the right one. That being the case, at one point, it will not be. This is not because we're unable to think about good monetary policy frameworks. It's because the world changes. And as the world changes, appropriate monetary policy frameworks will change with that. That's how it is. No problems with that. But that change hasn't happened in a way that forces us to change our monetary policy framework today. So we're thinking just how to tweak a bit at the margins. Thank you.
Thank you very much, Refet. And thank you, by the way, to the three of you. If I may say it on behalf of my fellow ECB policymakers, It's rather comforting to listen to the three of you this morning. So, thank you, Volker. It's always a pleasure to be in the ECB waters, but especially this morning. That said, there is no room for complacency. We will come to questions and discussions. Can I, Refet, reassure you perhaps on one point, because you mentioned the importance of looking at the euro area as a whole. I think this is what we do when we look at euro area figures in the Governing Council. At least I am ready to quote the growth figure for the euro area 24, 0.9%. So I happen to know the French figure, but this is by chance. So we now come to the lead questions. There are 4 of them. Can I ask you to put your questions in a row, and then you will have time to respond to the 4 questions. I hope the 4 questioners are with us. Jens Eisenschmidt from Morgan Stanley, Sarah Schmidtke from Bankenverband Mitte, Marco Stringa from Element Capital, and Christian Keller from Barclays. Should we start with Jens Eisenschmidt? Here you are. You were supposed to sit there, but it's to test our agility. Please start.
And I asked Volker, and he told me I'm here. Totally fine. A quick question. Basically, if we go back in time, say 3 years, or maybe 4, to the increase or the start of the inflation surge, a lot of papers started to surfacing in the academic community, which I here predominantly speak to, basically saying, oh my God, this is going to be very difficult. I remember an MBR working paper saying, looking at 20 periods of disinflation, and this is going to be super hard. Yet here we are, basically almost back to target, at least in the euro area. So I would pretty much side with Refet here on the analysis, has worked pretty well. And you know, of course, the problem with these analysis that we saw before, the mistake here was to take a different regime as the backdrop, a different data generating process. I would say the salient difference between back then and now, between the 70s and now, is that we have equipped ourselves with independent central banks, so we have a very good inflation fighting technology. So in the words of the ECB, the only thing that the ECB had to do was basically to say, yes, guys, we have seen inflation is up, we are going to raise interest rates. And then, of course, there's a bit of back and forth of how much you have to do this, but by and large, this prevented the ECB from having to go to 8%, could peak at 4%. Now, my question is, if that the one key thing that you want to tell somebody landing just on planet Earth in terms of what was the difference, it's independent central banks. I have 2 questions, and can be answered in 1 sentence. Are we up again for a regime shift? Is this a regime shift? And what is the salient feature of the new regime that we have to take care of, that we have to look for, that will inform the policy of central banks? Thank you.
Thank you very much. Sarah, you are next.
Thank you so much for your presentations. I actually have one question, because you mentioned so many risks and uncertainties, and I particularly liked your point, Refet, about the very much unknowns. So my question is on cryptocurrencies, because the US announced to hold a strategic reserve. So what's your assessment from an economic point of view? What implications could that have on the dollar exchange rate, for example, on inflation, which in the end may have implications for the euro area as well? Thank you.
Thank you very much. Marco Stringa is next.
Thank you very much for the presentations. The world, Europe, the ECB we all face huge uncertainty. Now, uncertainty tends to depress economic activity, for example, via investment. So what the best policy response in the short term? Should we be agile and lower the interest rate to offset that uncertainty? Or the central banker should be more concerned about the credibility and then correcting afterwards the easing once uncertainty goes back and look through the uncertainty? Thank you.
Thank you. And Christian Keller is last.
Thank you for the presentation. That was a short-term question about monetary policy response. Let me ask something maybe a bit more for the medium term. There's a lot of uncertainty that was highlighted, but one certainty that seems to be there now is that there's going to be a lot more defense spending. And we're talking about not, small amounts, but possibly in the case of this country, several points of GDP. So how do we think of defense spending with regard to the impact on the economy in Germany, but possibly beyond, in particular if Europe does this? Is this purely consumptive spending? Then the question arises, what did Europe do with that peace dividend they got in the last 30, 40 years? Because Europe and Germany did spend about 4% on defense in the late 60s still. That peace dividend, roughly speaking, I don't want to be too provocative, but it was spent on welfare states, on essentially increasing the social spending. Now, if you seem that we now need to do more on defense and that is consumptive, something needs to give. You cannot pay for this with debt. Or maybe a more benign scenario that this is a big investment boost. It's not only going to wages for soldiers, but there's this, what in the US happened was DAPA. You get suddenly productivity boost from spending on military. Maybe what we earlier hoped, and maybe we still hope would happen with green investment, green transition. You will get these breakthroughs in productivity. So that's my question to the panel. Thank you.
Thank you very much. Can I suggest each of you to respond briefly, perhaps in reverse order, starting with Refet, if you agree, Silvana. You are not obliged to answer all the questions, each of you. Be short, and afterwards we will open the floor to the audience. Refet.
Okay, very quickly. So is there a regime shift now? I don't see that. And I don't think so, but usually regime shifts become clear much later than they take place. So it might be that, I'm not fast enough. On crypto, US strategic reserve makes no sense. But crypto is here, and it has some uses, not as money, but as a payment system, a settlement system, and importantly, a money transfer system. If you ever had to deal with SWIFT, what a slow and exploitative system that is. Right? So crypto actually creates all kinds of regulatory issues on, having to know your customer and keep track of payments. We're used to doing this over the banking system, where banking system is well regulated in this regard. Now, if crypto is going to substitute, especially the less savory parts of the transactions, the part that we really want to keep an eye on, we'll have to learn how to do that. Not easy, but to me, the immediate policy concern about crypto is this. High uncertainty depresses investment. It does. And when investment is going down, that's a negative demand shock. Normally, we would expect central banks to cut interest rates to offset this. This is a case where the monetary policy working with long and variable lags becomes a real issue. Because if that uncertainty is not going to be long-lasting, but you happen to have cut rates already, you're going to regret this. It's a tricky affair because you don't want to be too late. You don't want to wait until you're in a deep recession because of the uncertainty and then begin to cut rates. But I don't think I would have done it already today. We'll really have to see whether this high variance is going to be a hallmark and a lasting hallmark of the Trump administration, so that uncertainty is there, or whether it's going to be a initial warming up phase that within a month, regardless of whether we like it or not, we will know what exactly they're implementing. On the defense spending, there are two things. So defense spending does two things. One, it's defense. Two, it's government spending. And it's really important to decide which one is the real aim. And those two things may not always be in agreement. So defense might tell you, okay, import a ton of stuff from the US. That's not going to be expansionary for Europe at all. But maybe it's good defense. I'm no expert on that, right? But what is going to be really important is how this is going to be structured. In particular, the US itself has benefited a lot from its own defense spending because they turned it into a technology R&D spending. Now, if our Europe is able to do something similar, that's going to be very good. We're going to lose less of the bright minds to the US because that's where the research money is. We're going to have more long-lasting growth because technological advancement is going to lead to that. and that's going to be homemade rather than imported. But the current issue, of course, the thing that started all of this was that Europe has defense needs, and they'll have to be addressed. And that's primarily a defense question, not an economics question.
Thank you. Klaus?
Yes, so thank you. I agree with Refet that I do not see central bank independence in the euro area in any way threatened. I think everyone has been coalescing around the current model, and it has been working well, and I see no big centrifugal forces in this regard, but who knows, we may be getting surprised. It's certainly true that it's important for the euro system to preserve its financial independence in order not having to go to ask to overly stretched government budgets to get recapitalized. I think that is something that everyone wants to avoid. And that, of course, given the experience we had in the past years with certain policies and how costly they could prove, is probably going to limit the appetite in the future for those. And that's something to be taken on board. Now, with regard to cryptocurrency, I think the US approach is, well, unusual, we could say lunatic. Because if you're a country that issues reserve currencies, why would you need reserve currency? You already have it. Unless, of course, you expect you're no longer going to issue reserve currency in the future. Okay, but maybe there are other motivations why they want to go into these cryptocurrencies, which have nothing to do with reserve starters or not, and that is probably the most likely explanation here. So I don't think if you have a reserve currency that you need to have a reserve fund of some other reserve currency. Now, with regard, I'm a bit in disagreement with the argument about how uncertainty and the depressive effects it has on economic activities should be dealt with by a central bank. If the uncertainty persists, it's going to permanently increase uncertainty, and that's a bit like a permanent negative supply shock. You can then not do anything about the real effects of that persisting uncertainty. Of course, it could be that the increased uncertainty is also going to increase demand for safe assets, and as a result of that increased demand for safety is making people willing to hold safe assets at a lower return. And that is basically saying that the natural interest rate could fall as a result. And if that is the case, of course, then it would be appropriate to cut interest rates in order to bring about that lower return that is required. But about the activity, if it's long-lasting, there's little you can do, I think. On defense spending, I think something that gets overlooked here, I mean, defense spending is not only material, tanks, helicopters, drones, what have you, it's also people. And to the extent that you have to withdraw a lot of number of people, say a whole generation for 1 year, because you're going to reinstate mandatory military service, this is going to be a negative supply shock for the rest of the economy in terms of the labor supply. And now these people, instead of producing goods, are going to produce defense or security. And it's not going to help in the rest of the economy. And I think that is something that needs to be quantified, how big that effect is, and it's something I fear could be quite substantial. And of course, the long term, I'm also hopeful that if we can spend on defense, that we're going to get beneficial, innovative activity that sort of then permeates the rest of the economy. DARPA has been mentioned. This is, of course, a very long-term effect, and the needs to rearm are very urgent, which basically means, at least for some extent, we will have to buy existing systems where this sort of knowledge spillover and new creation of knowledge is going to be somewhat limited. So I think the overall hope we should have in this generating, at least in the near term, very beneficial growth effects on spillovers into the rest economy, I would be a bit cautious there.
Silvana.
Yes. So, yeah, I agree with my colleagues on the framework not changing. Yes, I would add that central bank independence was a precondition. There are two other elements. It's about having clear mandates or remits for central banks, and I think importantly, a clear quantitative inflation target, because that helps in anchoring inflation expectations. On Sarah's question, I think the US decision is surprising and risky and a threat to global financial stability, and is something that should concern central banks around the world and should be watchful. On Marco's question, if the only shock we were facing was uncertainty, yes, the natural conclusion is that you should loosen policy and be cutting rates, but there's a lot more going on at the moment, and so those other factors will have to be weighed in. Klaus mentioned something that is interesting. Well, what do we do with permanent increases in uncertainty? I mean, again, you could argue that monetary policy could short-circuit some of that, if this is affecting investment or consumption, monetary policy by, stopping that from escalating would be a positive boost, not just to current demand, but also to supply potential as investment feeds in future capacity. But we have to ask the question of, well, what if we are in this different world in which we are subject to more weather-related events or geopolitical events that lead to, for example, shortages in critical inputs from energy to water and so on and so forth. And these are obviously questions that need to be raised and need to be addressed by fiscal authorities or perhaps supranational authorities. And we have to think about seriously about how to deal with that, because central banks can do very little about that. The most central banks can do is, when these shocks erupt, bring back inflation to target, but it's not going to solve the real consequences of these shocks that are creating uncertainty. So there is a need for a macro-proof strategy at the more global level to think about how to cope with these shocks. And if I may, I think the policy mistake, if we want to think of one, was that we were not prepared, and this is not about central banks, this is macroeconomically, we were not prepared for an energy supply shock of this magnitude. There were some countries that were ready and had diversified their technologies. Switzerland is a good example. They had the hydropower. They could resort very fast to these other sources of technology, but many other countries were highly exposed, including Germany, and that was obviously something that escalated the crisis. So we need to think about technological diversification, trade diversification, and eventually also perhaps think about building inventory basis to be ready for a food or water crisis or energy crisis and so on. So there has to be thinking prudentially about these big shocks. And Christian, on defense, I think the details will matter a lot. Pace, composition of spending, so as of now, it's all very vague. We know that some components of spending can have spillovers in innovation, and there's great work done on that for the US, and that can improve capacity in the medium to longer term. But of course, if that's shifted towards more consumption spending, that will be a different picture. So it's very important to understand how that is structured and what the pace will be. Thank you.
Can I add one word, putting together the two questions on regime shift and cryptos? I don't think either that I don't see at present a risk of regime shift in inflation. But the new US approach could mean a regime shift in currency. What do I mean? It's not a question of technology. Currency is becoming digital and tokenized, fair enough. We should keep the pace on that. But the question is, if the issuers of this digital currency are only private and not public, are non-European rather than European, then it could be a regime shift about stability, because we lose the public anchor, and about sovereignty. Let us say it for Europe. And this is where the two projects on central bank digital currency, which we actively pursued in the ECB and in the Governing Council, are of the essence. And I really believe that they are now much more relevant after the executive order of January 21st, with the two legs, digital euro for retail, which you mentioned, and also wholesale CBDC for financial markets. But we should keep a public sovereign anchor. I suggest we come to the questions in the audience. We could take perhaps 3 in a row. Be short, introduce yourself, and I have 4. So we will see. Please, madam, start.
Okay, thanks. Petra Gerard, University of Cambridge. Thanks for these great presentations. I have a question for Silvana. So you went into some of the increases in tariffs. What you haven't mentioned is that Trump's announcement of these reciprocal tariffs. So this could be have a major impact. So basically has announced that starting April 2nd, he will levy the same tariffs as other countries levy on US goods, which could mean a massive increase in effective tariff levels. So do you think this is just going to help bring tariffs down overall, or is it going to lead to much higher tariffs overall? Then Refet, so I fully agree with your, what you said about there should be better communications. You said less communications. I agree. It should be more focused on the quality rather than the quantity of communications. And scenario analysis is one way in which that could be done. In fact, scenario analysis is a great way of providing both clarity and agility in this high time of uncertainty. It's a great way of providing state contingent forward guidance. But then how should the ECB best communicate disagreements that they have and are likely to have in this time of uncertainty, given that they don't publish any voting balance? Thanks.
Okay. Can I clarify the framework, to use the words of the day? One question is one question. But thank you very much. And we will have still 3 speakers in a row. Please.
Chris Giles from the Financial Times. I've got a quick question for the panel. Refet asked a very interesting rhetorical question. You asked, what is the worst way that fiscal expansion can happen, and what should monetary policy do about it? So I'm going to ask that as a real question. What is the worst way that fiscal policy can happen, and what should monetary policy do about it?
One question does not always mean a simple question. Please.
Brief questions. Given the current economic and financial challenges, are the Maastricht criteria still effective in economy in the European Union? How do Maastricht criteria now are effective? Do we have to reform them? What do you think about the convergence of the economic unity?
And I had a 4th, last question here, just on the top, Krishna, if I'm right. And sorry for the others, but
thank you.
Volker, we are supposed to stop at 11:45, no? Apparently we are.
Thank you. Krishna Guha with Evercore Partners. When we have a substantial increase in government debt, for instance, as associated with this promised German defense and investment push, should we think of this as operating mostly on the term premium on government debt, or mostly on the overnight risk-free rate R-start?
Silvana, you are ready to start?
Yes, on the first question by Petra, I think it's a nightmare to compute those reciprocal tariffs, and I'm terrified at the thought of who's doing this job there. It's complex because you can think, okay, I want to offset the value-added tax, but then you have to take into account federal taxes, corporate taxation. I mean, it's a really difficult one, and I would be interested if someone has attempted that and done it country by country. On Chris's question, the worst case in which fiscal policy could happen right now, I think, is too much focus on short-term consumption spending with little impact on capacity. We really want this spending to be long-lasting, for the supply capacity of the economy. So that's why the composition does matter, and we want those spillovers into R&D and innovation that will sustain growth, ideally, longer term. And the last question, I think, markets are interpreting it as term premium right now, so not so much as RSR. But, personally, I would put some weight on RSR also increasing. It depends, again, the composition matters because that will end up affecting capacity as well as demand, and that's something to be taken into account.
Yeah, I just want to say something on reciprocal tariffs. These are not reciprocal. I mean, you know, VAT affects foreign and domestic goods the same way. There is no discrimination here. In fact, VAT is economically equivalent to a sales tax, which is something the United States has, and probably somebody should report that back to the United States. That's just, I mean, of course, I mean, what all this says is that it's made up, and it's a pretext, and that it's going to come no matter what. I think that's how you should read that. Now, the worst fiscal spending, I don't know. I can imagine a lot. I don't want to elaborate on it. But yeah, so on the Krishna's question about the term premium versus the short-term interest rate effects that come from government consumption or spending, I mean, this depends very much on the model you have in mind. If you think that the expansion of defense is going to have a government multiplier that is not, you know, that is below 1, for which we could have, you know, good evidence for. I mean, Valerie Ramey's evidence in the short run would suggest that could be actually the case, because there's some substitution of private consumption. And then, you know, you would get as a result of this spending an increase in GDP, but a decrease in consumption. And that decrease in consumption could actually be a downward force to short-term interest rates, at least, well, over some period. While the long-term premium effect could still happen through the increased fiscal risks associated with higher debt, the higher exposure to shocks that come as interest rates fluctuate and multiply now a larger amount of debt. The fiscal risks in the budget are just increased, and investors want to get compensated for that. If you have the view that this fiscal spending is going to be largely investment, it's going to have a lot of spillover effects, and productivity gains are going to come and therefore raise private investment, then you would get potentially an increase in the short-term rate associated with the spending. So it really depends on what is happening, for instance, to private consumption in the medium term.
Okay, so how to communicate this agreement? You can put out minutes and put some of it there. That's actually a good way. Another way is not to communicate it. You know, you have your disagreements, you talk about it, you come to a decision, and then it's the institution's decision, and that's done. And internal debate is nobody's business. I'm not totally opposed to this one either. But I don't think either way, the right way of doing this is every single policymaker coming out and talking about, you know, my take on this was this. Right. On, you know, what is the worst way fiscal policy can happen? One of the worst things that can happen is fiscal policy in Europe turns into tariff policy in the US. You know, there's continuous talking about this. There's continuous, we're going to do this. No, we're going to do that. We're going to do it tomorrow. We decided not to do it today, but the month after, whatever. But nothing actually is being done, so that you get all of the uncertainty of fiscal policy and none of the defense benefits or the spending benefits. And that sounds fairly terrible. Maastricht criteria, well, the treaty is still there, and there is much reason, I think, to think about revising it, because it's not good practice to have a rule and then to flagrantly disregard it. It's much better to revise the rule to be appropriate for the needs of today. Fiscal policy affecting yields, is it term premia or expected short rates? Okay, really a question of my own heart. Our models do a two-way decomposition, right? It's either expected short rates or term premia. But term premia usually has a proper definition for us. It's the quantity of risk times the price of risk. And here it may not be that. We get it as a residual, but it's very possible that there are also some market microstructure effects that get dumped into term premia. That, you know, dealer balance sheets can only take so much, right? You know, Germany is doing something massive, and this market can't price this, and the quantities don't get reallocated quickly enough, just because there are entities of fixed size, and the magnitude is much larger than that size. Right? So it might be that, you know, in a month's time, we're going to look back at this and say, you know, something happened. It was a blip that went away. And I will not think of this as term premia actually moving around. Or maybe it is going to be term premia or expected short rates. But I wanted to highlight that this third option is also there.
Thank you. If I am right, none of you answered the question about the Maastricht rules.
Refet did.
And was I wrong to think that it was a French question, again by chance? But I'm ready to say something about that, but would you like? No? Klaus?
Yeah.
You
Okay,
are the fiscal specialist.
Well, I don't know. But it would be great if we could get back to the Maastricht rules. I think they were a safeguard against centrifugal forces in the European Union, in the euro area. And they have their, their reason, and that the reason hasn't changed. It's just that currently they're somewhat, or at least one of them is currently out of reach in terms of the debt level. It should still be an aim to bring debt down, because it's a part of prudent policy to be able to respond to unforeseen events. And if you're overstretched already, you will be not able to do that. And as a result of that, the outcomes could be much worse. So I think it is there as an aim. And of course, enforcement of those rules has been a bit of a problem.
Can I follow with my governor's hat? I would share what you just said, Klaus. I think it's a non-starter, and sorry to say it this way, because we have been discussing the Maastricht rules since Maastricht. We have tried to revise them. The last time was at the end of 23, fair enough. I think there are no perfect rules. We all say they should be more simple, they should be more flexible looking at the economic situation, etc. But each time it gets more complicated. So I think we should stick to these rules. And may I have a dream, the Frankfurter dream, that these rules are not only implemented, as you said, but they are owned, and politically owned in each country, including my own country, obviously, including perhaps this country. Do we need specific national rules on top of a common European rule? Very cautious question. And I conclude making the link with what Refet said. We spoke this morning about the monetary framework, and we will speak again about it this afternoon. And we more or less agreed that the monetary framework of the ECB is adequate. Sorry, this is my takeaway from the discussion, but again, no room for complacency. My dream would be the following, that the Maastricht rules are not only seen as rules imposed by Brussels from outside, but that they are a fiscal framework, which we need, and where there is still room for discretion and adaptation and flexibility. We are not yet there, but I think we are lucky enough to have a stability and growth pact. Let us use it with some escape clause when necessary for defense, but I think the revision is a less good solution than an ownership. That said, President and Professor Wieland, I understand we have to stop. We are 1 minute late, but this is time stability. Thank you very much.